Welcome to Neppy Invests the World, episode 2, coming to you live on August 21st. So yesterday, Qantas released their 2020 financial year results. So I did receive this alert on my morning run. And usually if I receive an alert in regards to this, it just means it's something dramatic has happened. And if you just Google Qantas, you'll just see all these dramatic headlines. Qantas profit nosedives by 91%. Even BBC News going into the act, a $1 billion or £1 billion annual loss, and 2GB reported ghastly losses. So you would have expected, with these ghastly losses, the share price would have gone down. So ASX code is QAN. And you can actually look at yesterday's traders history. I've already got it up here. So 20th of August, share price didn't move at all. So, how could that be? Share price didn't move. In fact, today, share price went up 3.72, even though the market was down by a little bit. So what happened? Why did we see all these dramatic headlines about massive losses, yet the market responded, in fact, over the last 2 days, to the positive? Now, just for interest sake, disclosure sakes, I am not a Qantas shareholder. I have never been a Qantas shareholder, and unless the share price gets down to less than $2, I won't be a shareholder of Qantas. I'll never be a long-term shareholder of Qantas at all, and I'll discuss that why. But let's talk about, or let's see what they reported yesterday. So just going through the announcements, usually a company reports or gives out 4 reports. So a presentation, a speech, a media release, and this last one here, or the first one, the Appendix 4E and preliminary final report. That's the one I look at. It's less fancy, but it's got all the details you need to analyze a company. So Qantas, just zoom in there a little bit. Actually, I've already brought up this. So I've already got up the report here and zoomed in report, so I might as well just use this. So the first thing I want to talk about is, I'll just show you some things of interest in this report. And the first thing of interest is here on page 3, they do show you their investments. So they do hold quite a few investments here, including Hello World Travel, 15% of that company, which I think is a little less now just because Hello World did have a capital raising. So I think that's down to 12% now. A little bit of interest for me. Hello World is an ASX listed company, and it is, they do have offices on the floor below us at work. I'm not sure they still do. They might not be going to work anymore, might be working from home, but they used to have. If we go a bit further into page 7, page 7 just shows you some of the revenue from the different segments here. So passenger, freight, and other. Just gloss over that really quickly. But the main thing here is that freight revenue actually went up this year. Passenger revenue went down. And other revenue, which is a frequent flyer program, went down a little bit, but not all that dramatically. The next page is cash generation. I really like cash flows. And this goes through the cash flows. I'll get into that in more detail once we get the cash flow statement. But you can just see here, some interesting things here is the cash at hand at the end of the year increased by 1.4 billion. Net debt almost stayed the same. They did raise capital and raise debt, but raising, when you get to the end of it, net debt almost was stationary. It didn't move much at all. I like to look at this segment performance. This one is really interesting to me because they have 4 main segments: Qantas Domestic, Qantas International, Jetstar Group, and Qantas Loyalty. If you go to 2019 results, you can see Qantas Domestic was the main money spinner. So this is looking at earnings before interest and taxation. So this is what EBIT is. So probably around about half, or just less than half of their EBIT comes from domestic. And then the other three segments are almost equal last year. So international, Jetstar and loyalty, almost equal. But once you get to this year, you can see those three of them had dramatic drops in EBIT. So domestic went down 78%, international 83%, and Jetstar was actually a bit loss, went down 107%. But if you go to Qantas Loyalty, which is a frequent flyer program, it didn't go down by much. In fact, it was the main money spinner this year. In fact, if you look at the total underlying EBIT for total was 395, and Qantas Loyalty provided 341 of that. So without the loyalty program, they would have been, or Qantas would have been in much more dire straits, you would think. Pages after this looks at each segment in a little bit more detail. The main thing I want to look at here is the operating margin. So it shows you some good hindsight into, not hindsight, some good sights, good, whatever word I'm looking for here, some good clarity, I suppose, at what are their good segments. So the main thing I'm looking at here is operating margin. So Qantas Domestic has operating margins between about 11 and 13% until this year. So good money in Qantas Domestic. Once you go to international though, the margins there are much lower. So I would assume this is because there's much more competition in international flights. So fares have to be much more competitive, and that's why margins are much lower. Domestically, only really few competitors, and they can charge a little bit more for domestic. And Jetstar has pretty good margins here. So you can see why Jetstar is a popular segment or group for Qantas. Still 10 to 12% margins. That's phenomenal. But once we get to the loyalty program, you can probably understand why. There's been rumours in the past that investment banks have tried to convince Qantas to spin out the frequent flyer program. And the main reason why is this margin levels. So between 23 and 25% margins between 17 and 19. So really great, good margins, and then it's actually increased this year to 28%. And you can just see here the other things, revenue and underlying EBIT haven't changed much from year to year. Not much decrease this year. So even though we're seeing dramatic decreases in performance of the other groups, the loyalty program has not decreased much. So the best performance this year, so the loyalty program has performed phenomenally well. And then on page 13, they go into the risks. So this is really good, a good read about all the risks. So if you're ever thinking of reasons to invest in a company, you should always look at the risks involved. And a lot of times the company will give you the risks. And what's really interesting here is a line here, I'll just highlight it here, is in rare circumstances, black swan events, risk events can materialize, resulting in unexpected consequences such as what the aviation industry is encountering with COVID-19. Now, I get a little bit upset with this because this affected all the aviation industry around the world. At the same time, well, just before this happened, they were buying back stock at a phenomenal rate. And the question is, why were they doing that? Why were they buying back stock? A ridiculous capital allocation. I think it was ridiculous, and I think that sort of behaviour should be banned in the future. You should not be buying back stock. You should be increasing cash on hand because of these risk events, these black swan events. They happen quite often, and you have to be ready for them. And the aviation industry just was not. And the fact that they were buying back stock just highlights that. So really interesting that they quote that risk, yet they were buying back stock up until the time that risk occurred. So next thing we're going to look at is the financial statements. The main thing here is the income statement. I look at a few things here. So the revenue, main thing I look at. And then in the expenditure side, I look at significant increases or decreases from year to year. So we saw a couple of big increases, impairment. Here, impairment, so that increased by $1.4 billion. That's just reassessing the asset values. That's all that is saying. And then redundancies increased by 500 million. So when you get that together, that's $2 billion. And really, that is your loss for the year almost. So even though they reported a massive loss of $2 billion, about $2 billion of that was just because of those two one-off situations, impairments and redundancies. So the next thing I'm going to look at here is the balance sheet. So I like to look at, main thing is cash, so increasing cash. And the reason they got increasing cash, even though they had a loss for the year, was because they raised capital and they increased their debts. And you can see increasing their debts down in the liability section, interest-bearing liabilities. So current liabilities, they increased that by 200 million, and then in non-current liabilities, they increased that by $1.3 billion. So that's the main reason they increased the cash, is because of increasing capital and increasing debt. It's the main thing I look at here. These notes are something you might want to look at if you're interested in this sort of thing. But for instance, revenue received in advance. If you want to go to note 11, you can see what this means. It's pretty simple. What that means is just people who pay for tickets in advance, that sort of thing. That's what that means. And down the bottom is equity. I like to see equity, and so $1.5 billion of equity. So that's been cut in half, mainly because of the loss. And then my favourite is the cash flow statement. So they did see $1.5 billion of cash from operations, but then net cash from operating was $1 billion, but which was down by $2 billion from last year. But airlines are capital-intensive businesses, so they need to spend a lot of money on property, plant, and equipment. And we saw that even this year, $1.5 billion buying new planes, that sort of thing. And so because of that, we did see free cash flow was negative by about 400 million or so. So we would have seen cash coming out the door. And the only reason we'd see cash increasing, as I mentioned before, was shares or proceeds from share issues here, $1.3 billion, and increasing debt, 2.1 billion, actually it was 1.5. You take these two numbers, add them together, and that's 1.5 billion. That's why we saw an increase in cash. So it's good to see increasing cash, but we also saw an increasing at the same time of debt. That's the main things I want to look at here. I don't really want to go into the notes, but it's something good to look at. So next thing I'm going to take a close look at is, actually what I'll do now is something I do look at, and I just highlighted here. I look at whether it's good value. So with a capital intensive company, I look at the market cap and the book value or equity, and I like to see, for say an airline industry, I like to see it red. So I like to see the book value be higher than the market cap. And Qantas throughout history here, so I've got data going back to 2005. So between 2005 and 2014, their book value was always higher than the market cap. So I like to see that. And only since 2015, we've seen the market cap really run away from the book value by a large amount, which shows you they were probably running hot. The share price was running hot. The market value was running hot. They need a bit of a retracement back in the share price to get back to where I want to see good value in an airline. In 2020, so with the results now, so market cap is 7.3 billion and book value is 1.5 billion. So we still see the market cap well ahead of book value. So I'd like to see the share price come back. So I'm seeing a lot in social media about, oh, it's a good time to buy Qantas right now. It's cheap. To me, this shows you it's not cheap yet. Just because what's happened this year, the book value has decreased substantially and market cap hasn't come back enough to justify what I'm seeing in the value of this company. So unless the share price gets down to $1, I'm not going to be buying Qantas. It's not cheap, and you're not going to see much return over the next few years if it keeps at these prices. Charting wise, I'll go to the chart. So a really good time to buy, I'll just go back to this, was, you can see here, what I'm looking for here is where the red's the highest. So in 2012 and 2015, we saw good buying opportunities here. That's when the book value or equity was significantly higher than the market cap. When another way to look at it is sentiment was quite low. Actually, looking at the wrong company there. So 2012 here, sentiment in 2012 and 13, sentiment was really low. So if I go back to 2012 and 13 in June, those years, so this is looking at June. Let's go back. 2013, what years was it? 2012 and 13. So 2012 and 13 in June, the share price in 2012 was around $1. So June, July was around $1. As I mentioned before, I wouldn't buy this until I got to about $1. So this shows you that there's good value. But I remember back to that time, and there was a lot of rumors they were going to go bankrupt. So sentiment was really low, but a really good time to buy. We saw a lot of volume, which is another good sign. A lot of people coming into the stock. And we did see a shift in sentiment a few months later in November here. So around $1.27 would have been a good time to buy here. And then a year later, in June, July, the share price went back down again. Another good time to buy. So if you just look at value, so 2012, 2013, when the share price was around $1. So another good time to buy was December 2013. And then we saw a permanent shift in sentiment early 2014, and then the share price just rose from there. So if you zoom out here, that would have been a period to buy. So between about 2012 here and late 2014 would have been the time to buy Qantas. That's when it's at its best value. And then up here, if you go to 2018 and 2020, share price was running as high as $7. Worst time to buy, and simply because if you look at my little thing here, 2018, that's 2017-18, that's when the difference between the market cap and the book value was almost $7 billion. So no value at that point, and still not as lot of value. So I don't think it's a good time to buy. That's just my opinion though, even though the share price has come back a lot. So I think it's good to look at many factors, not just the share price, when you're looking at whether a company is good to buy. Equity in Qantas has nosedived. It's decreased a lot. We want to see increase in equity in the next few years. They are undergoing a lot of headwinds, and I'm just going to have this on my watch list, see what the share price does over the next few years. If it gets to like $1, even less than $1, I will become interested in buying Qantas, not for a long-term hold, or not for a never hold, just until it starts to see the share price increase, and then I'll sell it again. So that's all for today. Have a good day, and I'll talk to you later on the next edition of this podcast. Actually, it's not a podcast, it's a video. Catch you later.